Good afternoon. My name is Scott Zients. I'm the leader of our economic development incentives practice here at the Voorhees firm, and I'm honored to welcome you to yet another presentation during our 6th annual Voorhees Economic Development Incentives Conference. Over the past several years, through your participation, and we have some new people this year, of course, we've been able to grow into one of the largest economic development incentives conferences in the nation. We really appreciate your participation, and we're really looking forward to seeing you in person next year, where we again plan to host more than 300 folks in Columbus in February. Please fill out the survey at the end of this presentation. Let us know your ideas for next year. We read all those. Without anything further, I'm going to hand it over to Aaron and Michael. Take it away, guys.
Thanks, Scott. Appreciate it. We're going to talk today about how to maximize the benefits of your TIF, borrow it, bank it, or something in between. We're going to try and keep this as much a conversation between Michael Bernth and myself. So if you have questions, please don't hesitate to type them into the box, and we will get to them through the course of our discussion or at the end. And if we run out of time, we'll make sure and follow up with you afterwards. So we welcome your questions. Let me introduce Michael Bernth. Michael is a director with Bradley Payne Advisors, who he joined last summer. Previously, Michael worked for Stifel Nicolaus & Company, where he was lead banker on development, tax increment financing, special district port authorities, school district, and city transactions. In addition, Michael has extensive experience working with economic development projects in Ohio and has helped analyze and structure numerous financings. A focus area of expertise for Michael is his work with various types of economic development revenue bonds, tax increment financings, community development bonds, and private placements. Michael's a registered municipal advisor, registered with the MSRB, and the Securities and Exchange Commission, and he also holds a Series 50 license. Michael, thanks for joining me today. Let's talk about some TIFs.
Absolutely. Well, thank you. Thank you for having me. Appreciate it. Looking forward to this. So I'm going to just jump in and just kick this right off. First off, I just want to say, at Bradley Payne and as an advisor, we work hand in hand with all members of the finance team, and we're really there every step of the way. Our role is similar to that of a navigator. We're responsible for guiding you through some unfamiliar waters and really of the development and the bond issuance industry in general. So like I said, we're there every step of the way. We help model, structure, do all of that fun stuff. But let's just jump in here. And one thing I want to mention is, if you have a question, please bring it up. We'll make this very conversational. I know that's hard virtually, but we'll do our best to jump on questions and go from there. So, all right. Well, so you have a TIF in place. Now what? What are your main objectives for this TIF? What are you trying to achieve? What is the end goal? What are the optimal ways to monetize a revenue stream of a TIF? How can we best leverage this? What are our options? These are all big picture questions, but they're very, very important questions, and they need to be answered early on in the process.
So Michael, when you talk about objectives, what are some of the different objectives that you see your clients have? Are they looking to maximize cash up front? What are some of the other things that you've seen would be driving the transaction?
So it varies, Aaron. It's not a one-size-fits-all situation. I think it's sort of, I feel like the biggest thing is people don't always know what the TIF is going to produce. So it's really the first question out of the gate is what do we have here? So we have all these incentives in place. We may have an abatement, we may not, but we have a 30-year TIF. What is the cash flow? So we'll look at the cash flow, see what we can squeeze out of it, and then talk to the client. Then that becomes, yes, what are your objectives? Do you want cash up front? Do you want to, do you need $10 million for a project and we need to, have that in 3 months? Or are we going to take cash flows each year and slowly work on infrastructure projects as needed for the project? There's just various questions, and those are a lot of the bigger picture objectives.
So the first goal then as a municipal advisor is come in and kind of get your arms around, you have a TIF, but what does that really mean? What is your project looking like? What are the cash flows going to be? When are they going to come in? And that's going to depend upon what you're building. It's going to depend upon what type of TIF you've got. It's going to depend upon, a whole host of factors. And until you really know what the cash flows are going to look like and over what period of time, you really can't start even formulating a plan. Yeah. So
that's exactly right.
And so we've got a lot of different types of TIFs out there, and this isn't supposed to be, a real a nitty-gritty type presentation, but there are a lot of variations, and we always throw the term, 40B TIF, 41 TIF, and trying to assess that. But there's a lot of other things that you look at that may impact the TIF. You want to talk a little bit about a couple of those things?
Yeah, well, I'll just say too, just in general, when we're looking at, a 40B or a 41 TIF, and we're looking at various abatements, what type of TIF, how long, is it 100%, 30 years, is it non-school? I think what we like to do for the client and just for everyone in the finance team is sort of creating a menu of options that, you have a 40B, this is what that means. You have a 41, this is what that means. Here's the eligible improvements that you can finance with the 41, and it's, like I said, it's not a one size fits all. It's so intricate. It's so detailed per project, per, upfront financing, if you're going that route. So it's really creating that menu from the get-go, from the onset, and getting your whole team involved, getting the whole finance team involved right away on these topics and questions. And, I'd say the earlier the better, but it doesn't always have to be. I understand there's different situations where, as an advisor, we're not involved right away or just situation specific type scenarios. So then we come in and we run through that menu, and then we start getting into the weeds of the numbers and the cash flows and doing various scenarios at that point.
So determining, when we use the term a 40B TIF, it refers to the municipal section of the TIF code, although there are parallel provisions for counties and for townships. But 40B means that you're limited to public infrastructure costs. And a 41 TIF means that you can really use you can use the TIF proceeds to finance really anything, but a 41 TIF has its own limitations and some structuring things you're going to have to do to get things in place. In a 41 TIF setting, you got to get the city in the chain of title, right? So you're going to have a real estate transaction is going to have to fit within your timeline. And that may not work if your goal is to get cash up front right away. Trying to get a real estate transaction and have the property deeded into the city and then deeded back, it's going to take some time.
That's a really good point, and I actually have it later in the slide here where I just say timing, and it is really all about the timing. If we walk in and we need cash in three months, that may not be the appropriate route to take, and then we need to pivot and look at what else is a necessity and try to meet those goals. But it's really, setting your goals and finding that best approach to reach those goals early on. Then, just kind of digging in here a little bit on, we touched on the types of TIF, but, how going back to one of my first things, what is this worth? What is the value of my TIF here? And, based on the type of TIF, and like we just had the 40B, 41, we're not going to dig into that, but, how can we structure this TIF, and how can we structure the cash flows the best to monetize, every ounce of revenue available there? And it's hard. And going also and talking about the different types of TIFs, the biggest thing that comes up right off the bat is the base value. And Aaron, you touched on that a few minutes ago, but it really is all about the base. And what is the base value? When is that locked in? What are our options there? And then, once you do have that, how can I effectively predict what my revenue stream will look like thereafter? What am I doing here? What's the project? Are there various projects? Is this a phased build out over multiple years and scenarios and structures? that all plays into the modeling and structuring of the deal, and just kind of planning ahead of time and looking at all sorts of different circumstances to predict the values. And that becomes, everybody needs to be involved. Everybody needs to have their input. There could be other third-party revenue consultants involved as well. This is part of, eventually we'll get to, marketing a public bond issuance where these numbers are very important and they need to be honed in on. I get their projections, so they're not always accurate, and it'll change many times. I don't think we've ever projected and hit it exactly right. It's going to change over time. I have on this slide, is there any flexibility to extend my TIF? That was just a general point. Other situations, you've already had a TIF, you've had multiple projects going on that TIF, it's doing very well.
Right.
Should we look to council to extend this thing another 30 years? There's requirements and criteria, to do that. But, it's always wondering, is that flexible? Do we have that option?
Well, and that's a good point, because, each TIF, you can be adopting a TIF just for your project, or you could already have a TIF in place and the new project is adjacent to it and you're adding this land into an existing TIF. Or you've got a very, very successful TIF that's out there and is longstanding and has already paid for all of its public infrastructure improvements. Are there other options to use those revenues, excess revenues, to help support additional projects? All of these things can be addressed. The earlier you get involved, the earlier you'll be able to bring these questions to the front, see how many opportunities there are out there.
Yeah, no, absolutely. And getting involved early, I don't want to hammer that too much there, but it really does help the project. And I think it just, we can run more scenarios and we can look at things and dive in a little deeper than coming in at the end and you're kind of just restricted to a lot of things already in place. You don't have the ability to dig through agreements, work on agreements. It's a lot of things already set. One thing to, go ahead, Aaron. Sorry.
So we talked a little bit about the base value, but now we've got to figure out, okay, basic tax increment financing, we shouldn't lose that. What we're talking about is the incremental value that's going to be built above that. And so the increment is going to come from the project, it's going to come from the development. But then, there's a huge question in everybody's mind. My building is going to cost me $55 million to build. What's that going to generate in TIF revenues? You want to talk a little bit about how that kind of works and the skills that a municipal advisor can help bring to that?
Yeah, because you hear that 55 million number and it sounds massive and it's going to produce all sorts of revenue and we'll have no issue generating enough revenue through that TIF. We got to back into, so that's a very important number. So we need that 55 million number. We need to know what that goal is, but then we really need to back into and look at, okay, what are tax rates? What's this actual assessed value of this project going to be? How are we going to project that and understand that? And a lot of it's going historically and looking at historical tax rates and then just projecting that out forward. But that's where the abatements and things become a big issue. So if you have this $55 million building and it's hitting the tax rolls in 2023, but you have a 15-year 100% abatement, you got to figure out how are we going to monetize that period of time until the TIF revenues kick in years 16 through 30. And there's numerous ways to do that and layer on, do you have a minimum service payment agreement that takes an estimated value of that building? Is there a new community authority involved here? Do we run a charge on that property in the beginning years? Do we take half the abatement? Do we take 25% of the abatement? You just really start playing into what is the most efficient way to generate that revenue that we're going to eventually need to cover debt service. And that's sort of how we start start looking at these and really getting into the weeds. And I think this brings up the last bullet on this slide, actually, and then, you have all that. Who gets the excess TIF revenue too? So we have this project, we have it all laid out, and we've backed into all the values, and there's a coverage revenue stream falling to the bottom line. Where's that going? Who's getting that? And is there an agreement with the school district that the school district just picks up all the excess? Is it going to the developer for further improvements?
Other unreimbursed costs. Yeah, I mean, because we've got, and again, it depends upon what kind of TIF we're in, but if we're in a 40B TIF, you've got public infrastructure costs as you're limiting. There may be a whole bunch of additional eligible public infrastructure costs that aren't part of the financing that you're still able to be reimbursed for.
Yeah, and those are all important factors, and these are all those initial questions.
But always needing to keep in mind that, this is not and we can talk about this later as well, but, these aren't unlimited general fund revenues. They are revenues, right, the TIF revenues that have to be expended for a very specific statutory purpose, or and limited by the purpose for what the original statute was, or the original TIF authorizing ordinance limited it to.
Absolutely, and we all need to keep focus on that, 100%.
Okay, so now we've decided. It looks like that we're going to try and borrow against the TIF revenue stream. So our primary goal at this point is to get cash up front. As part of the capital stack, you're going to need you need upfront dollars. What are the options in front of us now?
So this gets into how do we monetize this revenue stream? How do we look at the valuation of this revenue stream and the cash flow projections? And how do we leverage this? How do we put this together in a nice package that we can borrow against? Are we going to go and sell this to the market? How do we do this accurately and efficiently? And I know we just said timing, but timing on here is again, because it's all about when do you expect these projects to come online? When does this hit the timeline, the tax rolls, and when is private financing closing? When is the construction begin date? We're kind of, all these roads have to sort of be traveled at the same time, and these pieces need to come together, at the same time to get this done. And so this is where we're getting into really modeling and doing a master plan in terms of a pro forma of everything that's going to be going on in the project, and calculating it all out, running scenarios, running stress tests. What type of coverage are we going to need here? Do we have future phases that you're not planning on yet, but we should keep that in mind when trying to structure this debt. This gets into the school compensation agreements, other local levies. You can't just forget about those. Those are very important. You got to net out your TIF revenues, and that's what we're truly ultimately borrowing against. And growth factors. Growth is always a big topic that I feel like I hear a lot about from developers mainly. If I'm working with a developer, it's what type of growth can we put on this? You're in an area that's just growing and things are just booming. We still have to look at this conservatively. I think the market norm is running with no growth initially, and factoring, can this stand without any growth, which just seems unlikely because most things do tend to grow. But look at last year, things are anything can happen, and anything does happen.
We've all practiced long enough now that there was a pretty fixed building, and inflation was part of the market and the way to do things. And then 2008, 2009 hit, and we went backwards. And how did that affect modeling? Now we've gone flat for a period of time, but that leaves dollars on the table. So kind of fitting that balance, that risk tolerance. Is that a developer and an issuer preference? Is that a market and a bondholder preference? Who's weighing those risks and who's taking those risks?
It's both. It's everyone, I think. And I think everyone sort of has a different agenda there in terms of the growth and how we're layering that into, say, a public bond issuance. What we see a lot of times, if it's a project, say mixed use development, and we have, a good revenue stream, we'll structure a senior bond issuance and have a nice coverage, all based on no growth, and then use basically your growth as your sub debt coverage. So the developer and the investors on that piece would be getting a higher interest rate because it's a more risky play. I mean, you're basing it on growth, and you're using that growth revenue to back into a number. But the general
a sponge bond, as we sometimes call them, to help soak up some of the extra revenue and almost equity-like in terms of,
yes.
of the developer getting some return on investment here, for they're still putting in contributions, and the proceeds still need to be used in accordance with the TIF statute. But it's a way to help make sure that you're maximizing every revenue that's available to you.
And like you said, it's fun. You're soaking up everything that you can and applying that across. So there's riskier.
When you've got these TIF revenues, there are a couple things that we can do. And a lot of times we talk about sort of structuring a standalone bond deal where you just are looking at the TIF revenues. But there are other avenues that the TIF revenues can be used. You could be looking at something where again, using the term municipality kind of broadly, but if this is, true public infrastructure that the municipality could otherwise use a GO, a general obligation debt for, it could issue its GO bonds, but really be using and counting on the TIF revenues to keep the subdivision's cash flows whole. So they pledge their GOs, but they're counting on the TIF revenues to make sure that there aren't any lost dollar revenues. Is that something you see a lot of?
Yeah, we do see that, and obviously that's a big credit to the deal. That's a nice, what I would say, a nice solid deal, and that's going to do well in the marketplace in terms of just a true naked TIF deal, if you will, on its own. And we do see that a lot, and but you can understand there's some municipalities who don't want to come in and do that for various reasons, and
it's a risk, right? Because now the municipality is taking the risk. They're the ones who are assuming to the GO that if these TIF revenues don't generate, they're going to have to dip into their general obligation funds in order to make the debt service, because it's a full faith and credit pledge. They're going to have their own wants and needs that'll be satisfied with the project. But there are a lot of AAA rated cities or AA rated cities look at this as this is what they're supposed to do with their credit, is to help create this growth. And when you've got real road infrastructure, real true public infrastructure, it can be a really good investment of their dollars. And then over time, once those TIF revenues prove out and start generating, they can really treat those then as self-supporting securities that don't impact their debt coverage for their next GO bond deal.
Yeah, I mean, so much changes once that TIF project and those TIF revenues reach a stabilization. Then they're on their own. They can stand on their own. They're much more secure, and you're much more able to sell a public bond issuance based on that alone. And yeah, you're not digging in to your GO balance or funds, and that's a really important point. I mean, all these development deals that I work on, the first couple of years are just the critical years. You have all your construction risk. You just have so many risks associated with, is this actually going to be built? What if the apartment market completely changes while we're building this out? Are we going to switch this over to try to go condos or vice versa? Or on the private side of things, is it really hard and difficult? We're in the middle of this project, we're going along, and is it extremely hard to line up private financing for a hotel piece? Everything else is there and ready to go. How do we pivot? How do we change this? And so there's just varying factors. Or we have another sort of pandemic, and now the demand for things has just collapsed, and we were projecting and banking that it would be there. But I think that goes back to my comment on growth, and taking a conservative approach. And many of these we run stress tests too. So let's say, we have zero growth, but then we also run, well, what if value is 85%? Can the project stand in that situation? And very important.
Well,
the worst case scenario is always very important.
Yeah, and we got a good question from the audience going back to the sub debt, and the question is whether sub bonds in a TIF offering can be tax exempt. They can be. It's really going to be the same test that you look at in terms of whether you have both private business and private use. You can only have one. You can't have both. And so they certainly can be tax exempt, and you're going to want your bond counsel opinion to cover it. You could also structure them taxable to help generate a higher TIF and a higher interest rate return as a result. If you want to have extra security on top of it, a lot of different options that you can float to structure it.
Very good question.
Those bonds are generally not part of the public marketing, right? Those are bonds that generally you see placed with either the developer or related parties of the developer.
That is correct. Typically, your senior debt would be the public market debt, and then your sub piece, which is typically a smaller piece as well, is defined and then marketed either to developer affiliates, developers themselves, sort of, Aaron, like what you said, kind of almost like an equity piece into the deal. So much different investors, typically investors who are able to take on a risk of that type of bond deal. But yes, they certainly can be tax exempt.
All right.
Slide we have up in front, we've covered some of this, but, what will this fund? What is this TIF going to fund? What are we looking at here? True public infrastructure related to a specific project, the roads, streets, parks, utilities, streetscaping, potentially a community center, things of that nature. If we're not borrowing, like I mentioned earlier, up front, and we have these TIF cash flows coming in on a yearly basis, are we going to use that just to support ongoing infrastructure of the project? One way to utilize it. Could we let it accumulate a little bit and then target something 3-4 years down the line when we're going to expand some roadways? Those are options. And you just got to look at the pros and the cons of all those. A lot of this, the market plays a big factor in here too, in terms of, let's say you are doing the public route, and where are interest rates? What are we thinking? Where are they going up? Are they going down? Should we jump at this and get in the market as fast as possible? Do we think rates are going down in 2 years? Which nobody has a crystal ball. I certainly don't. And it's ever since I've gotten in this industry 10 plus years ago, I've always thought rates would start to go up, and they've went down every single year for 10 plus years, which is just
every year I say going down, and every year I'm wrong. So but it's something to be mindful of is that and basic math here is interest rates go down, the amount of upfront dollars that you can attract for the project goes up.
Right.
And so, as interest rates rise, you're going to be able to generate less dollars. But then if you don't need the capital up front, as you take away construction risk, as you take away valuation risk, are those factors going to greatly outweigh, any change in the interest rate environment, so that if you wait and are able to self-finance and keep the dollars within the developer and just paying out, you may be able to issue the bond 3, 4, 5 years down the road, after you've got full valuation, after you've got a historical TIF revenues. Now you've got a much stronger credit.
Absolutely, and those are very important considerations, and it's always trying to play into what's the best approach. What do we foresee at that point in time? Because you're right. Once you're selling TIF-backed bonds that is on a development that's already stabilized, much lower interest rates. So you kind of factor that into your scenario. Is that a better approach? One other thing here on this slide, just, beyond the support ongoing infrastructure, are we reimbursing for qualified costs that have already been incurred? The TIF can be eligible for that in situations, but they just need to be approved costs and eligible costs. And that's really diving in and getting into Aaron's world, and he will tell us what those are on that project and specifically.
It's going to depend upon both what type of TIF you've got, what type of cost these are, and whether if you're going to be borrowing tax exempt or not. Because if you're borrowing tax exempt, there are additional limitations that may apply that wouldn't apply if you're going to reimburse yourself on a taxable basis. So those are all the questions that we'll try and get our arms around early, and it's always better to have these questions before you've spent the dollars, as opposed to, hey, we've already spent the dollars and we'd like to try and get them back. We can sometimes make that work. Most times we can, but not always. So the sooner you ask the questions, the quicker we can provide the best path to solve your problems.
Mm-hmm. Yeah, definitely. Earlier is better, as I keep saying. Moving on a little bit here, I know we've talked a decent amount on upfront financing, but just from my perspective, upfront financing seems to be the most common approach and meets the objectives. That is just the most. We walk in and a client, what do they want? They want the money up front. They want the money now. So we got to figure out how are we going to get the money up front? How are we going to work through all these things we just discussed, and how are we going to get them the most amount of money in a timely manner? So as this is going into just covering over here again, a public bond or note issuance is typically what we're talking about in this situation. These bonds, may be issued by a municipal entity. Different security types come into play there, and depending on the level of the direct issuance of that said municipality determines some of your credit support. And this is kind of what Aaron was saying before. And so then, the bonds could be rated at the level of that municipality if they were coming in with a decent credit backstop of, say, a GO sort of obligation on this. Privately placed debt is another option. In that situation where we're marketing to specific investors, specific banks, entities that are known to come in and play in the development space. They're very knowledgeable. They know the credit. They know the construction risk. They know the ins and outs of all these projects. They know the different TIFs. They know all the agreements. So you have a limited audience, good, because they're sophisticated and they know what they're getting into, but it can also limit you in terms of flexibility, and they're going to look for very specific things. So it just really, really depends on what you're looking to accomplish. And then one other thing too, typically it's a little less intensive in the marketing book, but most private placements do have a full offering document. So it's not much different in this situation in terms of development type deals. I put on here loan programs. That's another option, just as a quick example. I don't want to go too deep into this unless Aaron wants to add, but like OWDA has several loan programs, brownfield, stormwater, that are specific and would have to go through a loan application process, and the funds would have to be eligible specifically on that project for those specific uses. And Aaron and I actually worked on a transaction involving OWDA and these loan programs. And it's an efficient way to finance early and upfront. And if you qualify, the rates are very good and are typically lower than, going right private placement or into the public market. I don't know, Aaron, if you want to add anything on,
I think
those.
It's definitely something to always keep in mind, is that when you have the TIF revenues and you've got another source of maybe incentive financing, it could be state infrastructure, it could be Jobs Ohio. those funders may be willing to take the TIF as the collateral that they're looking for as well. So we can structure that as part of the transaction. I think some of the other loan programs, and we've always got bond funds issued through port authorities as part of as sort of a way to access the capital markets that are less tied to your specific credit and more tied to the credit of the entire pool. And those transactions tend to work best in the $5 to $10 million range, or if you're going to get more, you're kind of above the $8 to $10 million range, you're going to want to get a couple port authorities involved, which adds to the layer of complexity. But then again, now we've done this for the last probably 5 or 6 years. I think we've been doing that, or maybe it's even longer now. So some of those inter-party agreements have been worked out and are now pretty formulaic.
Yeah, no, that makes a lot of sense.
The next slide is the bond fund slide. Jumped ahead.
Perfect timing. I like it. And so this slide's really talking about, I would say, always something that we discuss and talk about at length and at detail and scenario after scenario is, do we go non-rated or do we run it through a bond fund? And it's a hard discussion at times, and it just depends on the deal. It depends on the timing of the deal. And like Aaron has mentioned multiple times, if we're a couple of years in, we may go the non-rated route because we have some history. We don't just have a pile of dirt sitting out there. There's some development on it. Let's say we're a year into a project and there's actual construction going on. All the private financing is closed, and we're digging into the ground. Apartments are going up, or a year away from maybe completion. That may be a better situation for a non-rated deal because it's actually started. Or if it's a bigger development, there's actually some pieces of the project components complete. You would go that non-rated route. But in the early on stages, the port bond funds do really add a great deal of security to these transactions, and they're great tools. There's many bond funds across the state of Ohio. They have various ratings associated with them as well. And so in those situations, where a project is accepted into that bond fund, the bond then would carry that bond fund's credit rating, which is a huge plus. You're in a very risky stage of the development, but it meets the requirements and it passes through the bond fund's approval process. Well, now your credit on the deal is basically that bond fund. And when marketing that to the public, it's really the credit strengths of the bond fund that you're marketing. Yes, the project plays
Oh, go ahead. Sorry. Let's talk a little bit for the audience members who maybe don't have as good a sense of what the difference is between non-rated and rated. What are we talking about ratings? What does this mean from both the project or the buyer or the financing?
It all comes down to interest rates. So if a bond fund has a triple B plus or an A minus rating on it, your interest rate is going to be lower than what a typical non-rated development deal would achieve in the public market. So that just represents more money to your project. If you
by rating, we're talking of rating agencies. We're talking S&P, Fitch, Moody's, and a process where you've got to go out and submit your project to these agencies for a rating, and their rating is based upon what?
Their rating. So the rating on a bond fund is different than how, let's say a standalone deal would attempt to be rated, which having a standalone development deal rated does happen. It's just more rare. It needs to be large, and it needs to have history, and it needs to have a lot of different guarantees in place, some backstops in place, high coverages in place, a strong additional bonds test. I don't know how much detail we want to go into all those areas there. I mean, it gets pretty complex, and the rating agencies, I would say S&P mainly. I don't want to say who's better and who's not, but S&P just historically has rated development deals better. They just, I believe their system is more set up to understand the nuances that come along with these sort of projects and deals.
So
S&P typically.
Sorry. So if you're a political subdivision, you've got your geo debt outstanding. You probably have already been through a rating process. It's likely
Yes.
that your debt rated and you understand that process. But if you're now involved in an economic development deal and you're selling a security that's not your geo, it's going to be something less than that. And if you're selling unrated debt, you've got a different pool of buyers who are interested in your project, because the buyers who are interested in rated debt, in what we call investment grade debt, are looking for that high quality. Municipalities almost never go bankrupt. I'm knocking on wood.
Yes.
It's rare. It's a really solid credit, better than your highest rated corporate credit. Your AA rated city is much better than a AAA rated corporate credit. But when you're talking unrated, you're now into below investment grade. You're into high yield, and you've got a totally different buyer. So you're
limiting your buyer pool as you move down the credit spectrum to a lower grade. Your buyer pool just gets smaller and smaller. We almost get into the private placement discussion I just had, and you're going to get your very sophisticated Preston Hollows of the world, your Nuveen's of the world, high net wealth retail will come in at times if they're sophisticated enough. It just depends. So you're just limiting that. You start moving up in the rating category, you're opening it up to many more investors. And I think that's one of the pros with the bond funds. It opens up the doors to a much wider pool, and you get bid on more, and that could help your rates drop even further than you're projecting, thus driving more cash into the project. And that's sort of the whole assessment analysis we go through in the early stages of these deals, and trying to figure out what's best and what's appropriate. I'll say too, timing again, in terms of just, you got to look at the market at that point in time. Like right now, for instance, it's a low supply market. Interest rates are historically low. This actually is a good time potentially if you went non-rated, because you're going to get just more investors are looking for yield. And that's where it's at. But that applies too. If it's triple-B, they're going to be all over that as well, because that's going to be a bit higher yield than a traditional geo, muni that's a AA plus or something. So development deals in general, I'd say, are timed right now to do very well in the marketplace. That can change quickly, and that will change quickly. So that's not saying run out and go do it immediately here. So, but if you're in a position to price in the next couple of weeks, you're great.
Pricing is good. So a question from the audience is really on timing. Is so you've got all the agreements are in place. What is the time to market, and the time to from when you've got your TIF in place, you've got your other transactions, the other documentation done? How long does it take to get to the market?
Yeah, so all your agreements are in place. Your private financing's closed. You've received all approvals from whatever authority or municipality you're going to issue through. At that point, it's really you're engaged with an underwriter, who then you're really talking to their desk and assessing. That we're all working together. Looking at the market, what's the supply like in the next few weeks? But really, I always say if it's a more complex deal and there's more of a story behind the transaction, you're going to need more time in the market just to market that deal. 2 weeks is typically a good, rough, hard number on marketing. And that what I mean is that's you're printing your final offering documents after you've got all your approvals, and it's distributing it to the trading desk. They send it out to all their brokers. Everybody's marketing your deal now at this point. 2 weeks in the market to do that, and then you set a pricing date. So then at that point in time, you would actually, the morning of pricing, a couple hour window, you open it up to the traders and they get feedback. They could get feedback during the marketing period too. Hey, we don't like this additional bonds test. We have some issues with this. So you could be getting that feedback during that 2 week window as well. But typically it's, on that pricing date, you get feedback on interest rates and scales, and we all assess that. And that closes then. Typically it's another 2 weeks until you get your money. So you're setting the rates on one day, another 2 week is a standard closing period. So, that's a 4 week, a month window roughly after all approvals are in hand.
Yeah, the actual time to market and price bonds and sell them and close them is probably the shortest time period of the entire transaction. Yes. The longest time period is getting your arm around all of these questions, getting the documentation in place, lining things up with your private financing if this is a private deal, because that's huge. Nobody's going to be the first dollar.
That's huge.
So we're not going to close on a TIF deal and give you access to the TIF dollars if you don't have your private financing lined up to do the actual construction necessary to generate the private financing. So that's always kind of, and it's always a bit of a dance to try and figure out who goes first, how this is going to work, and everybody's got to get comfortable, because the private financing is also saying, hey, this project doesn't work if you don't build that garage. Where's your garage dollars coming from? And, we got to get everybody comfortable and along the same line, and herding cats to get everybody in the same place is a large part of the job for everybody.
Yeah, and I would say 8 out of 10 times deals get delayed and pushed back due to private financing being delayed or pushed back, and or you're working with the bank and they have a credit issue and you got to look for someone else potentially. That's typically what we see. But after that, like you said, you're ready to go, and that's the shortest part of the process. But during that time, you're also getting your offering document ready. You're not just sitting there. You're all paths are leading to the end goal.
We can't do these things serially. We've got to proceed all along the way and get everything ready to go. And it's a lot easier if you're doing a bond fund transaction as opposed to doing a standalone public offering. That documentation is going to look a lot different. If you're doing a private placement with a sophisticated single buyer, you don't have to worry about your disclosure. But they're really going to be driving, what they want to see from the private financing side, and they've got their own checkbox. They're just one more lender in your capital stack that everybody's going to have to learn how to get along and make sure that the mortgages all line up, because we're all looking to the same piece of property to provide security for the private loan. It's the same piece of property that provides security for the TIF. It's just a different cash flow out of it. It's the pilot as opposed to the actual underlying value. All right, so we've spent about 48 minutes talking about the most common, the upfront financing, because that's the world that we live in. Most transactions need capital. That's why they come here, but that's not always the case. So we've got other options. You're a developer. You've got access to cash somewhere else. What are your other options here? We've created this cash flow.
Yeah. So now we're getting into a reimbursement situation here, and so the developer entity has a lot of money's already been spent. A lot of things have went on. You're not doing the upfront approach, and you can be reimbursed for your prior costs as TIF revenues are received and taken in. This goes back to the type of TIF and all those things, but they need to be approved, eligible costs. You can get, Aaron, I don't know if you want to dig into the interest and how this rate is negotiable and how detailed we want to go into that. It really is municipality specific. It's
the grantor of the TIF. Yeah, I mean, it's the entity that is establishing the TIF is going to determine, whether interest is statutorily authorized as a permissible cost, but the statute doesn't set what the interest is. And so the entity granting the TIF will decide what they think appropriate interest is, and each entity has its own view of that. Some political subdivisions, and I might disagree with their approach, but it's their approach, look at it and say, hey, we could borrow at our own geo for this. We're not going to, but that's the interest rate that we're capped. So we're looking at, a bond fund index, the AA rated, or the revenue bond index, these publicly disclosed bond buyer index ratings out there. That's what we're going to cap you at. We push back on that and say, hey, that's great, but this isn't really that, because this is one project. We've got construction risk. We've got valuation risk. We really need a higher interest rate risk, or people aren't really going to invest in that. And it's just part of a negotiation, and there's no real set way to do it. But, you can't really say, hey, what would the market pay for this? Because a lot of times on an unrated thing, there's not a lot of market for this type of debt. If there was, we would be selling it. There just isn't a market for this particular project. What's an appropriate interest rate?
Yeah, and in trying to decide what would the market pay for this specific thing, it's very, very difficult, because a lot of times, like you just said, there's not any comparable, exactly similar transaction that you can go and look to and be like, oh, they got a 4.25 for this type of structure and this debt. So it becomes a challenge, and it's a negotiation. It's a back and forth process. And Aaron, yeah, as you said, you're right. It's always, typically this is a spread to some benchmark bond buyer rate, and that's how they base it.
Yeah, and my advice is always not to have a variable rate of interest on your reimbursements, because you're setting yourself up for years of complicated calculations and an unnecessary level of complexity. I'm a big fan of fixed interest rates for these things, because this is a 30-year marriage that you're getting into, and let's not do calculations each year that are harder than they need to be, because the spreadsheet guys aren't always around 15, 20 years down the road, and it just simple is better.
Simple is better, and you just kind of hit the next slide there. The reimbursement approach, less costs, less paperwork. You're not going through the offering document we've talked about. You're not going through this big marketing period. It's just a much easier approach. And you don't always have the finance guys there, although we want to be there. There's just timing, and the project changes, and people move and change and leave and things of that nature. So you're not always going to have the same team 10 years down the road that you had when you established it.
That's right. Well, the party processing, if we're talking about reimbursements, these are payments coming in. The county collects the taxes. These are pilot payments. They head them over to whoever, the city, the township, who set up the TIF, and now they've got to administrate it, pay it out. And those personnel change. Every couple of years, you're going to get somebody new, and how's that going to get processed? There's just, trying to get everything lined up. Reimbursements can sometimes work well, and sometimes not as well.
Mm-hmm. Oh, absolutely. And then, just some of the disadvantages of the whole reimbursement we just discussed. The interest is negotiable. That can be a pro and a con, obviously. And if you get locked into a situation where, it is based on a geo index and the project's risky, so you're getting a much lower rate of return than you would have otherwise. You're not getting your cash up front. Biggest negative there. And then that's why we spent, I think, a lot of time talking about the upfront financing. Just from my point of view, that does occur much more. People want the money, and the project needs the money right away. And
yep. And as we touched on earlier, you can marry these two together. You can decide to do the reimbursement through the construction period. You can carry through the stabilization period, and then elect to securitize it. But you just have to be mindful, if you're going to do tax exempt financing, you've got to put that a reimbursement declaration up front, so that you can then reimburse yourself tax exempt down the road. You can't spend the money and then 5 years later decide we're going to reimburse ourselves on a tax-exempt basis. That's not going to be permissible. As long as you put a stake in the ground, say, hey, we intend to reimburse ourselves with tax-exempt debt, we can do that some period in the future.
Mm-hmm. Definitely. Aaron, did you want to get, I know it's 3:55 here. We got this last slide. Did you want to get into any of these questions potentially? Or I know some we've covered, quite a few.
We've covered it a couple. I mean, I'll go real quick on the bank aid. I mean, you can just hold on to these funds. If you've got the dollars that are available, they can sit in the TIF fund and hold them against future needs. And they can be able to be there. I think, well, it was last year or the year before, one of the speakers at our legislative panel talked about how advantageous it was for their city to have TIF so much of their area, and it's provided a huge amount of revenue over time that gave them a lot more flexibility. Just as a reminder, you are subject still to, it's not general fund revenues. You've got to use it for public infrastructure improvements. And generally, using that legal word generally, they have to be something that benefits the parcels in the TIF area. And I say that generally because from time to time, the statute, the Ohio legislature has adopted laws that create something called a remote TIF, the ability to use TIF funds for projects that don't directly benefit the parcels. Those windows open and close for different periods of time, and you have to take action during that window to declare the TIF a remote TIF. And it's got to meet some tests usually set up by the legislature for when they open that remote TIF window. You can also expand the TIF as property grows. Very successful development. There can be parcels along the edge that are now ripe for development, but need extra public infrastructure, maybe some additional roads, some additional sewer, maybe some sidewalks to help bring it as part of the development. Those parcels can be added. But you may, depending upon how the TIF was set up, you may be subject to the original time periods within the TIF. You don't necessarily extend the life of the TIF just by adding a new parcel in, unless it was set up as something what we call a rolling TIF, which right. is that each parcel can serve as its own 10, 15, 30-year period. But whether you can do a rolling TIF or not is a political question determined by each of the political subdivisions. All right, so real quick, can you comment on minimum service payments and impact on underwriting? Michael, you want to talk a little bit about what minimum service payments are?
Yeah, so minimum service payments really come into play, especially during the abatement period, when basically if you're just taking your TIF and you have some improvements, your improvement, you just have your base value during this 15-year period of time. So we need to establish some sort of revenue to cover your debt service. So you're taking a valuation on the assessed value and calculating what this payment is that we need to sort of cover debt. I mean, the way I always look at it, we're kind of backing into what that minimum service payment should be based on, we got a $10 million bond issue and we need to cover debt at 125 times. So our minimum service payment needs to be whatever that value is to cover. And it's based on the projected assessed valuation of your parcels. It can be layered over multiple component types.
It's a risk shift. It's a risk shifting issue, because if you just have a TIF out there, the bondholder can only get paid based upon the TIF revenues that are collected, and that's going to vary based upon how much the actual assessed valuation is and what the future tax levies are. And by and large, that's not a risk that most bondholders or any bondholders are going to take. They're going to put that risk back on the developer. They're going to put it back on the projects. That even if the pilots there's a shortfall, you're going to have to make additional payments on top of it to make sure that there's always enough funds in there to pay the debt service on your TIF bond. Those minimum service payments still have the benefit of the tax lien. So they still come ahead of a mortgage payment. They're not accelerable.
Absolutely.
which is why they're great for security non-underwriting practice. They are, however, private payments if you're looking at whether you're going to have taxable or tax-exempt debt. So once you have a minimum service payment, then you're very focused on your private business use. You can't also have private business use because you've got your minimum service payment, or you're just going to be into the taxable debt.
Very favorable underwriting, though.
Yeah, it's, if you're doing a bond fund deal, it's going to be required. I can't think of a bond fund deal I've ever done that didn't have it. If you're doing a public deal, it's going to be required. The only time it's not is if you've got related party, friends and family. It's part of the transaction, and then you're just kind of limited then to your pool of buyers, and it's going to probably stay with friends and family for some period of time. Mm-hmm. So, Michael, I want to thank you for joining us. We're at the 4 o'clock hour. I know there were a couple questions we didn't get to. We will make sure that we get follow up with those individuals and get you the questions. One I can get to real quick. The county TIF section is 570978 in the Ohio Revised Code, and then the rest of them we will follow up. So, Michael, thank you very much for joining us, and enjoy the rest of your afternoon. Thanks, everyone.
Thank you for having me. It was a pleasure. Appreciate it.